Hello, my name is Lon Welsh at Ironton Capital, and I want to welcome you to National Diversified Fund 8. Very briefly from the attorneys, there's a lot of forward-looking statements in this about what might happen, or what we expect, or what we plan. Those are based on our best estimates as a company and the information that's provided to us by the sponsors, but you'll want to double-check everything with your financial advisory team of your financial planner, your CPA, and your attorney. A lot of company source information in here. And again, it's our best available estimates that we've got right now. Finally, this is not an offering of an investment opportunity. That comes in the legal documents from us, particularly the subscription agreement and the offer memorandum. This is just informational. If you find this interesting, we'd be delighted to share more detail with you so you can fully evaluate the offer with your financial team. Getting the legal stuff out of the way. Our target return is a 17 to 20% internal rate of return, IRR, for this fund, and that would be over a 4 to 6 year period, and that is after all fees. We don't anticipate there'll be any liquidity in the fund. If you're newer to us, these are the prior funds that we have run, the dates, and then the returns that we expect to receive. 15% for our first fund, and then the rest of them are between 16 and 20%. We're anticipating this fund's going to be in the 17% range. So you can passively invest in real estate with this. You're not actively invested at all. No work taking calls from tenants and shoveling snow. Here's the investor team on the investment committee that does the due diligence and boils the ocean to find the opportunities for you. We've got outside accounting, tax, audit, and internal control support, so your money is safe with us. There's a little bit of an overview about what's the responsibility of the general partner, so myself and the other guys on investment committee, and what's your responsibility, which is all very, very passive and very relaxing. So our strategy is to diversify the investments in several ways, and the first is geographically. So this gives you an illustration of, for the first 4 funds, where were the investments placed. Our expectation is if we raise around $10 million in Fund 8, we'll make approximately 10 investments of about $1 million each. Our goal would be to get exposure of 8 to maybe 14 different states and as many as 30 to 40 different commercial properties with the one investment that you make. So it's like getting a mutual fund of commercial real estate that spreads your risk out across a lot of assets. How have we done historically? Well, the first fund had 8 investments, and we are tracking to a 15% annualized return. Just as a quick highlight, we had one incredible project in McKinney, Texas, a build-to-rent project with a 54% annual return to the limited partners after all expenses. And if I tell you that, I've got to tell you that we had a complete stinker. We bought an office building to renovate in Houston right before COVID, and that's going to be a total loss. The other projects came in more or less as planned. As far as time variance, you can see that the first 4 projects all came in either on schedule or a little ahead of schedule. In one case, 2 years out of schedule. We've got 3 projects remaining. All the renovation or construction is complete in those projects. We're just waiting for the right time to sell. So the main thing here, the value of having a large diversified portfolio is that even when you've got a stinker like our office building before COVID, we can still achieve a 15% return so that you get your principal back plus a healthy return on top of it. So we talked about geography in many different states. The strategy, our goal is to do about half new development and about half renovation of existing assets. We'll have the same approach, I hope, for this fund as well. Asset class, we're not a huge fan of office anymore. That'll eventually change. The majority of the investments will probably be in multifamily, with a little bit scattered across hospitality, industrial, self-storage, and student housing. Fund 1 didn't have any industrial, but we've had quite a bit of it since then. We are a fan of industrial. So that gives you a sort of an idea of the macro philosophy we're going to try to accomplish. The cost and returns, just very briefly, if you've invested in other private equity funds in the past, this will look really familiar to you. The important thing to know is I have 2 share classes. One class has a lower preferred return and it gets no depreciation. So if you're investing in a self-directed IRA, for example, your CPA may advise that's the correct vehicle for you. On the other hand, share class B gets a lower preferred return it gets all of the depreciation. So in our last couple funds, a $100,000 investment with us would generate $40,000 to $50,000 of depreciation in the first year. For many of you, you can use that to offset a capital gain. So if you're saying, for example, selling a 4-unit apartment building, you're tired of being a landlord, you want to get off the treadmill, you don't want to deal with a 1031 exchange, you can use this depreciation, check with your CPA, in almost all circumstances to offset the capital gain and mitigate your tax exposure. And if that's your situation, I am delighted to talk with you and help you craft a strategy to maximize the tax advantages. So you have to be accredited. The way to be accredited is if you're single and you have a household income over 200 grand, if you're married, have a household income over 300, or if your investable assets are over $1 million, any one of those three makes you accredited. You just have to tick one of those boxes. As John points out, I believe I have moved my money from an unpredictable market subject to many economic factors and significant risks to a fundamentally sound business model that's a hedge against inflation. I recommend them to my friends and family with confidence. As Tom explains, determining where to invest is incredibly challenging in this environment. Lon has a freakish ability to understand and analyze real estate deals and know where and when to direct funds for maximum gain. As Shalom points out, although real estate investing can be lucrative, it does come with risk. He chose to invest because he feels that the knowledge and expertise to make informed, strategic decisions with my capital, also while prioritizing safety and responsibility. Would you like for us to do an investment review for free? Go to irontoncapital.com/review and choose your time, and we'll be able to deep dive with you on your personal view and goals and answer any of your individual questions. Sound good? We have a lot of projects in the works, so our time is limited, so please go ahead and secure your spot now. We can't wait to see how we can help you with your investment goals as our gift to you.